All right, let's do a high quality video analysis for the potential ideas heading into next week. This is a contextual analysis based on the internal battle of buyers versus sellers and, of course, the external context of the markets. So, next week, the external context is fairly simple. We have FOMC on September 17th, and that FOMC event is likely to create range bound parameters for RTH on Monday and Tuesday. What I mean by that is that the market is likely to enter a phase of digestion and consolidation as market participants await the economic report on September 17th. So we'll see how the FOMC event creates a massive directional move, or we will see if the FOMC event on the 17th is sideways chop, because anything is possible. You have to be prepared, you have to understand your trade plan, and you have to be ready for anything. So from an internal contextual perspective, last week was a true trend week to the upside. If I zoom out here on this 1 hour time frame, I'm going to draw this fib using the September 2nd's low to the September 5th high, and you can see that we pulled back into 50% of the September range at the time, in which this showcased a healthy continued macro trend as 50% of the September range was bought. But more importantly, the September 4th RTH low was bought as well. Price action created a false breakdown here on September 5th using the September 4th low, and since then a daily low has still been unable to break down, showcasing an immense lack of volatility on the charts. That's what sparked a true trend week to the upside. And we'll talk about the higher time frame structures. As you guys know, I trade with the institutions, I trade against the retail traders, so my edge is in patience. I am on the higher time frame chart waiting for macro dips in a bullish environment. But let's go ahead and talk about the intraday levels. So first of all, last Friday's low, it must break down. We must break down a daily low if sellers are to return, if volatility is to return. So last Friday's low is right here, 65.83. That must break down in order for price action to contest the all-time high breakout structure from last Thursday. So last Thursday's CPI event successfully broke out all-time high. If we look at Wednesday, the Wednesday PPI event tried to fade all-time high, which of course was just the September 5th high. But because price action was able to sustain higher lows, because a previous day's low was unable to break down, the CPI event was healthy, it was strong, and we got successful all-time high breakout expansion, printing bullish time frame alignment. So if last Friday's low is to break down, then 65.62 and 65.66, the breakout structure from last Thursday, that is a must hold, in addition to the CPI low, the prior 2-week high 65.41, and last Thursday's low 65.52. Those levels must hold as well if the intraday trend above the previous all-time high, September 5th high, is to continue. If all of this structure fails, then we must zoom out to the higher time frame. Let's take a look here at the structure in which we will not be scared to buy the dip, because the 4-hour chart is bullish and it is healthy until proven otherwise. However, keep in mind that next week we have the FOMC event on the 17th. So really and truly, anything is possible. You must stay on your toes and you must apply the entry models such that you do not get run over and you have good risk to reward, maintaining your psychology, right? So 64.8925 last Tuesday's low, that's 50% of the September range, and that's also a minus 1.7% dip. That's somewhere that I will 100% be interested in from a macro time frame perspective to buy the dip. 64.8925 is the first level of interest, the first higher time frame high quality low of interest to apply my entry models. Below that, 64.52, the Friday September 5th low, and then we have 64.2650, the Wednesday September 3rd low. So each retracement within the September range so far, because the previous all-time high has already been expanded upon, is significant. We know that the charts cannot go up forever. So when we do start to pull back, which retracements are holding, that's going to showcase showcase how strong buyers are, and that's going to showcase the level of volatility in the markets. So the 0.382 and the 50% holding, that's going to showcase a continued healthy macro trend. The 618 holding, that's going to showcase a little bit more volatility, but the trend can still survive. And then the lower that we go, the more bearish that the chart could get. But we have to keep in mind that the lower that we go, the better the risk to reward gets, and the more aggressive we may have to get until the context of the chart changes. So if we do break down 6360s, for example, with three massive 4-hour lows here, three massive institutional accumulation lows, then maybe a correction is in store. Maybe the external context, the volatility is a little bit too much for buyers to withstand, and we must adapt to a changing environment such that we do not get run over, right? That's going to be all for today. Thank you so much for listening. I'm attaching the blueprint report to this video, whether you're watching on X or TikTok. Definitely look through the blueprint report. It has all of the literary information. All of the levels are posted. All of the charts are posted. And the stream recordings from last week, Thursday, and last week, Friday during RTH are posted as well right here. And I have amazing examples from my Trading Wars Discord in the SPY VIP if you guys want to read up on any of the examples from my real-time commentary in the Trading Wars Discord. Thank you so much for listening, guys. Enjoy the rest of your weekend. Good luck next week. And if you need me, I will be available in the Trading Wars Discord. Head over to tradingwars.com if you want to join the family. Thank you so much for listening. I'll see you next time. Good luck.